All right, let's dive into a classic Wall Street puzzle. We're talking about Duluth Holdings and their latest Q3 earnings report. Now, on the surface, some of the numbers looked pretty good, but the market's reaction? Oh, it was a total and complete disaster. So today, we're going to get to the bottom of this huge disconnect. Just look at that number. That's what happened to Duluth stock in a single day, right after their earnings call. A nearly 30% collapse. So the big question we have to tackle is, what on earth caused such a massive gap between what the company reported and the market's absolutely brutal verdict? So here's our game plan to figure this out. First, we'll look at those headline numbers. Then we'll dissect exactly why the market reacted so harshly. We're going to examine the two competing stories here, this turnaround story, then read the tea leaves in their guidance, and finally, we'll give you our take on what to watch for next. Okay. Let's start right at the beginning with the numbers that really kicked off this whole firestorm in the first place. And this is where things start to get really interesting. You look at the bottom line, adjusted earnings per share, they totally blew past expectations. They posted a loss of just 23 cents when analysts were bracing for a 46-cent loss. I mean, that's a huge beat. But then you look at the top line, the revenue, and they missed. They came in over $2 million short. So you've got this weird situation. A big win on profit, but a pretty worrying miss on sales. So that begs the question, right? How does a massive earnings beat lead to such a brutal punishment from the market? Well, that's the core of the drama here, and it's what we're digging into next. You know, on paper, with that big profit beat, you could absolutely frame this as a win. And believe me, management certainly tried to. But the market saw something else entirely. It saw a much deeper issue that the bottom line numbers just couldn't hide. It's a classic case of Wall Street looking right past the profit number and asking, okay, that's great, but how did you get there? And even more importantly, where are you going next? And that question, well, it reveals a tale of two very different stories being told at the exact same time. You have management's story, which is all about improving profitability, and then you have the market story, which is all about a really dangerous decline in growth. This slide just captures that conflict perfectly. On one side, management is taking a victory lap over some big operational wins. Gross margins expanded nicely, adjusted EBITDA shot up by 5.5 million year over year, and they got their inventory under really tight control. But the market was fixated on the other side of the ledger. Overall revenue was down almost 10%, and, this is the alarming part for a digital-first brand, their direct-to-consumer sales plummeted over 15%. And this quote from the CEO, Stephanie Poos, it really tells you everything you need to know about management's perspective. Their focus was clearly, squarely on profitability. And from their point of view, the plan they put in place was working exactly as it was supposed to. So how'd they pull off those profit wins? Well, this slide breaks down their three-part strategy. First, a huge promotional reset. They literally cut promotional days by more than half, which of course is going to lead to higher margins. Second, they got really strict with cost discipline, putting them on track to save about $12 million. And third, tight inventory control. All of these are smart, disciplined moves to make the business healthier. But, and this is a huge but, here is the painful trade-off. That promotional reset, while awesome for margins, had a huge negative impact on their sales. And for a brand that was built on a direct consumer model, seeing that core channel shrink by over 15%, wow, that is a massive red flag. It kind of suggests they might be losing their customer in this quest for a higher profit on each sale. But you gotta remember, the market is always looking ahead. So the real damage wasn't just in the Q3 numbers they reported, it was in what management said about the future. And the crucial point is right here in the guidance. While they actually raised their profitability outlook a bit, they significantly lowered their sales forecast, cutting the top end by $30 million. This was the signal the market just could not ignore. It basically said, hey, this sales weakness isn't a one-time blip. We actually expect it to continue. This all boils down to one key concept: top-line pressure. It's the challenge a company faces just to keep its sales from shrinking. And investors are worried that Duluth is basically trying to shrink its way to profitability. Sure, the margins look better on a smaller sales base, but if you keep losing customers, at what point does the entire business just become unsustainable? That is the fear that drove this massive sell-off. So throughout the earnings call, management kept hammering home these themes: restoring price integrity, focusing on their core products, improving operations, paying down debt. And look, those are all fundamentally good things. but none of it answered the market's biggest question. Where is future growth going to come from? So with all that as context, let's move on to our take. What should we expect from Duluth's next earnings call and beyond? So after that dramatic 30% drop, where do the stock and the company actually go from here? What happens now? We see a three-stage path unfolding. In the short term, that intense focus on margins should provide a bit of a floor and support their earnings. But heading into the first half of next year, we fully expect that top-line pressure to continue. The real true test is going to be in the second half of 2026. They absolutely must show that customer traffic and sales are finally starting to stabilize. Specifically for next quarter, Q4, here's our prediction. We expect revenue to be down, probably again around that 10% year-over-year mark. But thanks to those margin gains, the EPS number should actually show strong improvement. Because of this push and pull dynamic, we think this stock will likely just trade sideways, kind of stuck in a range, until management can present a really clear and credible path back to growth. And that brings us to our final rating. We are initiating coverage with an underperform. Listen, the operational improvements are commendable, and management really does deserve credit for that. But right now, the risk of a shrinking customer base and this severe, ongoing top-line pressure are simply too great to ignore. Until there's a clear sign that they can stabilize sales, we believe the stock will underperform the broader market. And that's our take on the great disconnect at Duluth Holdings. As always, just a reminder that this is our analysis for informational purposes. It is not financial advice.